Hello everyone, this is Kevin Zhao, your finance professor at MTSU. Today we are going to go through chapter 2, financial statements, taxes, and cash flow. And I think this chapter serves as a brief review of Accounting 101. Now, you might ask, why should we go through accounting stuff when we are learning finance? And here's the thing that I can tell you. If you are seeking a career in finance, then accounting is something that you have to master. Right? In order to do a lot of financial analysis that we will learn in the later chapters, you know that all of the financial analysis are based on accounting information that we can get from financial statements from a corporation. So here is the difference between accounting and finance. Right? Accounting is about interpreting business activities in corporation in the past. So here's what finance people need to do. Finance people need to make a lot of financial decisions in order to maximize shareholders' wealth. They do financial analysis, financial planning, capital budgeting, so on and so forth. And all those things are based on accounting information that we can read from financial statements. So accounting is very, very important to any finance people. And the thing here is, finance is a forward-looking principle, and it take a look at what will happen in the firm and what we should do in order to achieve our future goals. But all of the future things should be based on what happened in a corporation, which can be which is reflected in financial statements. So let's go through a brief review of Accounting 101. And in this chapter, you will know the differences between many different concepts. The first one is the difference between book value and market value. The second one is difference between accounting net income and the cash flows. And the third one is difference between average and the marginal tax rates. And the last one is learn how to determine a company's cash flow from its financial statements. And here are 4 topics that we will discuss in this chapter. First one, the balance sheet. Second, the income statement. The third one, corporate taxes. And the last one, cash flows. Now, let's take a look at a balance sheet. And what is a balance sheet? Well, from your accounting class, you know that balance sheet is a balance between assets and the total liabilities and equities. And essentially speaking, the balance sheet is a snapshot of firm's assets and the liabilities at a given point in time. This is a snapshot. It only shows you a picture at a given point of time, and that given point in time typically is the end of a fiscal year or end of a quarter for most corporations. And let's take a look at the structure of the balance sheet. And the balance sheet, on the left hand side of the balance sheet, you see all the assets in a corporation, and those assets are listed in order of decreasing liquidity. Right? And what is liquidity? Liquidity means the easiness of transforming certain assets into cash. On the right hand side of the balance sheet, you see all liabilities and shareholders' equity. And also all those items are listed in decreasing order of liquidity. And the reason why we call this financial statement as a balance sheet, because there's always a balance between assets and the liabilities and the shareholders equity, and we call this as a balance sheet identity. And here is the structure of a balance sheet. Once again, on the left hand side of the balance sheet, you see current assets and fixed assets. And the current assets has higher liquidity, and the fixed assets have lower liquidity. On the right hand side of the balance sheet, you see current liabilities, long-term debt, and the shareholders' equity. Right? So accounting is an amazing business tool for any corporations, and the principles of accounting was invented back to 17th century in Italy by Italy businessmen, and they figured out a smart way to double check the money in a business. So sometimes businessmen need to check if there's anything missed, anything was stolen in their business, and I think about double checking is critical for them to find out if there any missed item or anything that is stolen. And the way that they do double checking is to double check, first of all the available assets in the business unit, and also they ask where does those financial assets come from, and those financial assets are either owned by debt holders or equity holders. By checking both aspects of business, they can be they can be sure that okay, nothing is missed and nothing is stolen from their business. So accounting principle was established back to 17th century in Italy as a smart way to double check the security of all assets in a business unit. And here you see there's a difference between current assets and a current liability. And current assets are assets that can be transformed into cash within the next 12 months. And the current liability is the money that a company has to pay back in the next 12 months. And the difference of those two items is called net working capital. And the fixed assets are assets that can be transformed back into cash beyond 12 months, and long-term debt are that liability that the company need to deal with beyond the 12 months. And the difference between total assets and the total liabilities is equal to shareholders' equity. And you can see this very clearly from balance sheet identity. So here are three features of balance sheet that you need to know. First one is net working capital. And the net working capital equals current assets minus current liabilities. And net working capital provides a cushion for a corporation to deal with daily liabilities, and a positive number for net working capital indicate a healthy day-to-day operation of a firm. And the liquidity, second terminology is liquidity. Liquidity measures the speed and the ease of conversion to cash without significant loss of value. And liquidity is critical for any corporation, and liquidity is valuable in avoiding any financial distress. And the last feature here is, of course, the balance sheet identity. And here you see the balance between total assets and the total liabilities and the shareholders' equity. And also, if you manipulate the equation a little bit, you see that shareholders' equity is the difference between all assets minus all liabilities. Here you see an example of a U.S. corporation balance sheet, and this balance sheet is for the end of year 2014. And as you see, balance sheet provides you a snapshot. It only offers you a picture what's going on in your firm at the end of every fiscal year. And here the end of fiscal year is December the 1st, and you see balance sheet was established at the end of every fiscal year. And here you see two columns, and any balance sheet will offer you two columns, one for this year and one for the last year. And here you see the numbers for year 2013 and 14. On the left hand side of the balance sheet, you see assets. All the assets are listed based on liquidity, and the cash has highest liquidity. In year 2013, that is $104 million, and in year 2014, it increased to $160 million. And also you see account of receivables, inventories, as well as fixed assets on the left-hand side of the balance sheet. Right? And when you add up all the assets together, you get total assets, which equals $2.7 billion in year 2013 and $3.1 billion in year 2014. On the right-hand side of the balance sheet, you see current liabilities, long-term debt, and owner's equity. Within the category of current liability, you see two very common items. One is account payable. The other one is notes payable. Accounts payable are money that a company need to pay back to their suppliers within next 12 months, and the number was $232 million in year 2013 and $266 million in year 2014. And the note payables are money that company borrowed from the bank, and those amount of money need to be paid back within the next 12 months, and that number was $196 million in year 2013 and $123 million in year 2014. As you see, comparing year 2013 and 14, total current liability has declined from $428 million to $389 million. The long-term debt are money that the company borrow from typically a bank, and they don't need to pay back the principal within the next 12 months. Instead, they are going to pay back the balance in future years. And owner's equity are money belong to shareholders, and here you see shareholders have total interest of $1.9 billion in this company in year 2013, and the number increased to $2.2 billion in year 2014. Once again, when you compare the left-hand side and right-hand side of the balance sheet, you see a balance. For year 2014, total assets is $3.1 billion. And on the right-hand side of the balance sheet, you see that the sum of liabilities and the owner's equity equal to $3.1 billion, and the number should be identical. Otherwise, something is missing, something is stolen. And the balance sheet gives us a small double checking to see if there's anything missing in a company. Now, let's take a look at what's the difference between market versus book values. And the book values are values on the book. So the book here is financial statements. And the book value is the value of assets, liabilities, and equity on the balance sheet. And you can actually read that number in the financial statements. And the market value are very different. And the market values are prices at which assets, liabilities, or equity can be actually be bought or sold on the market. And the market value can be different from book value. For example, a total equity for a company could be $3 billion, but the market value for equity could be either higher or lower than $3 billion because the investor and the market value company very different. They look at future cash flows that can be generated from the corporation, as those future cash flows are considered as basis for determining market value of liabilities or equities. However, on the balance sheet, you see a static representation of liabilities and equities, and that's why book value is often different from its market value. Here you see an example of book value and market value for a corporation called Klingon, and the book value of total assets is $400 billion, while the market value for total assets is $600 billion. And on the long-term debt side, market value and book value equal to each other. That could be the case, but for equity, they often are different. Book value was $600 million, but the market value is way higher than that. It's $1.1 billion. Why market value is much higher than book value? Well, book value actually look at the static situation of shareholders' equity. It doesn't account future cash flows. But when investors evaluating shareholders' equity in the long term, they look at future cash flows that can be generated from a corporation. And that $1.1 billion of market value is based on future cash flow of the company. So here's a critical difference. Right? Book value reflect what happened in the past. But the market value look at what will happen in the future. What will happen in the future. So book value is something that can be estimated by accounting people, but the market value is something that can be estimated by finance people. Now let's switch to income statement. Income statement measures the performance over a specific period of time. Right? That could be a fiscal year, a fiscal quarter, so on and so forth. And it measures operating performance. And the ultimate goal for income statement is to figure out how much money that the company made for their shareholders. And that number is net income. That is the result of income statement. In order to compute net income, we start with the revenues or sales. Then we consider all the expenses, all the costs associated with generating sales in a corporation to get net income. And here's a very easy equation that you can see within the income statement. The net income essentially equals all the revenues minus all the expenses and the costs. This table shows you a very typical sequence of income statement. It starts with net sales or revenues, in this case $1.5 billion for US Corporation in year 2014. Then we consider all the costs and expenses. The first one is cost of goods sold, and it includes direct costs and indirect costs. Then we minus depreciation. Depreciation is non-cash charge. And after we consider both cost of goods sold, depreciation, we get a very important number called earnings before interest and taxes, or EBIT. EBIT. Right. So EBIT often was referred as operating income. Operating income is another measure of income from a corporation. The difference between EBIT and the net income is that net income measures the money the company made for their shareholders. But the EBIT measures the money that the company made not only for shareholders but also for two other stakeholders within the corporation. The first group of those stakeholders are debt holders, and the second group of those stakeholders are U.S. government, or IRS. And once we subtract the interest paid to debt holder, we get taxable income. Then we continue to subtract taxes, which is the money that the corporation paid to IRS or U.S. government. Then we come up with net income. So here we have three measures of earnings. First one, earnings before interest and taxes. That is, earnings belong to, first, debt holders. Second, U.S. government in terms of taxes. And the third one, shareholders. And the taxable income include all the earnings belong to the U.S. government, IRS, and shareholders. And the net income measures the earnings that belong to shareholders. And in this case, the net income is for $12 million for all shareholders. And once company made money, they will give it back to shareholder in terms of dividends. And in this case, the company paid $103 million of dividend to shareholders. Right. So you may ask why company didn't pay all net income back to shareholders dividend. The question here, the answer here is company needs actual money for future investment. So company can make more and more money for its shareholders. So the money that is not, the amount of money that is not paid back as dividend to shareholder will be kept within the corporation in form of retained earnings. Those are earnings that has been retained from net income. For a corporation, in this case, retained earning equals net income divided by dividends. And here the number is $309 million. When you read a financial statement, you should be aware of so-called GAAP. What is GAAP? GAAP is General Accepted accounting principle. And different countries have different gaps, and gaps actually regulates how accounting items can be recorded in a typical financial statement. And there's a matching principle within GAAP framework. And the matching principle recognizes revenue when it's fully earned. And GAAP also requires that expenses to be matched to generate the revenue for the certain period of recognition. Right? And the second item you need to pay great attention to is so-called non-cash item. Non-cash items are expenses charged against revenue that do not affect cash flow. And a typical example for non-cash item is depreciation. What is depreciation? Depreciation is expenses charged against the sales for the usage of long-term assets within a firm. Right? And depreciation is an expense item in the income statement, but this expense does not require cash outlay because it's non-cash item. So this depreciation is non-cash expense item within the income statement. It was accounted as expense, but it does not involve any cash usage. In terms of costs, there's a difference between fixed costs and variable costs. If company has lower fixed costs or higher fixed costs, then it will affect its operating leverage. But the fixed cost, the variable cost, is not fully incorporated in the income statement. And many corporations are practicing so-called earnings management. What does earnings management mean? Well, essentially, earnings management means earnings can be manipulated. Earnings number can be misleading number for shareholders and other stakeholders within a corporation. And the purpose of earnings management in most cases is to smooth earnings. Sometimes company made bad earnings in bad years and some good earnings in good years, but they want to stabilize earnings over years. Therefore, they manage those numbers to smooth earnings. And you would say, hey, that's not ethical. That could be illegal, but actually, U.S. GAAP allows plenty of room for the company to manipulate earnings or manage its earnings. And globally, we have different gaps across different countries, right? And some countries allow even more rooms for earnings management, and the U.S. GAAP, I can say, is the one that is the most conservative compared to other GAPs. But right now, U.S. corporations accounting reporting is going from U.S. GAAP to international GAPs. Now let's take a look at the tax issues for a typical U.S. corporations. And here you need to understand the difference between marginal tax rate and average tax rate. The marginal tax rate is percentage of tax paid on the next dollar earned, and average tax equals total tax divided by total taxable income. So why marginal tax can be very different from average tax, and here's why. This table shows you progressive tax schedule for a typical U.S. corporation. By saying progressive, it means that the more money company makes, the higher tax rates will apply. And in this case, if company is making profits between 0 to 50,000, then the tax rate is 15%. When that number goes up to the range of 50,000 to 75,000, the tax rate will increase dramatically from 15% to 25%. And if company is making, let's say, something between $335,000 to $10 million, then the tax rate for that portion of money would be 34%. But if company makes more than $10 million, then the tax rate would be something between 35% to 38%. So essentially speaking, the more profits company makes, the higher the tax rate it will be. And the marginal tax rate measures the tax rate for the next extra dollar earned by corporation. So here's an example. Suppose your company earns $4 million in taxable income. Then here are three questions. First of all, what is firm's tax liability? Second, what is the average tax rate? And fourth one, what is the marginal tax rate? So here let's do a little calculation based on progressive tax schedule for U.S. corporation. And here we apply different tax rates for different amount of profits, and based on calculation you see that taxable income is $4 million and the total tax liability is $1.36 million. So here average tax rate equals 1.36 million divided by 4 million, it equals 34%. And since company is making $4 million, which is between $335,000 and $10 million, the marginal tax rate is 34%. So for every dollar the company earned beyond $4 million, it will be taxed at 34%. 34%. And here average tax rate is equal to marginal tax rate, and it's not necessarily the case for other scenarios. And here once again, this table showed you the progressive tax schedule for U.S. corporation. And here, the second table showed you the different average tax rates for different U.S. industries. For example, for utilities sector, the average tax rate is nearly 34%, but for biotechnology company, it's just only 4.5%. So the average tax rate can be very different among different industries. Here's the last topic that we are going to discuss, which is associated with cash flows. Cash flows. All right, cash flows, most important thing for finance people, because finance people need to work with those cash flows to make financial decisions. And cash flows can be read from financial statements in a very indirect way. And in both balance sheet and income statement, you don't see any cash flows. You don't see any cash flow. In the balance sheet, you see the financial condition of the firm, and in the income statement, you see the operating performance of a company. And most people pay attention to net income in the income statement as shareholder, but shareholder needs to know more beyond that number of net income. They often need to examine very intensively how much cash flow that has been generated within the firm, so they can make forecast, make financial planning in terms of how much cash flow that can be generated from corporation in the future. Right? So in this section, our goal is to figure out how cash flows are generated from utilizing assets and how cash flows are expanded to finance assets purchased and the usage of different type of assets. So as far as cash flow goes, there's many different concepts. The first one is cash flow from assets, which equals to operating cash flow minus capital expenditure or net capital spending minus change in net working capital. And cash flow from assets can also be calculated as cash flow to the sum of cash flow to creditors and cash flow to stockholders. Right? Though cash flow from assets are cash flow that belong to both creditors and stockholders. And here you see an example to see how we can calculate cash flow to assets. First thing that we need to do is to figure out operating cash flow. Operating cash flow equals EBIT plus depreciation minus taxes. Essentially speaking, operating cash flow tells us the cash flow that can be generated from daily operation for both shareholders and creditors. Earnings before interest and taxes, in this case, equal to $694 million. And we add back depreciation. Why? Because depreciation is non-cash item. Because it was excluded. It was excluded from calculation of EBIT, as you notice in the income statement. Right? Depreciation was excluded before we get earnings before interest and the taxes. But depreciation is non-cash charge. In terms, if we need to recover the truth of cash flow, we need to add it back. Right? And since government is not in our consideration, therefore taxes need to be excluded. And often company need to use cash flow. You need to use cash flow to deal with tax payments. So that $212 million tax payment should be excluded in our calculation. So operating cash flow in this case equals $547 million. Then we look at net capital spending. Net capital spending. Right? That is money that a company spent in acquiring new fixed assets. And it equals ending balance of net fixed assets minus beginning balance of fixed assets plus depreciation. So that is a net capital spending. And change in net working capital equals ending net working capital minus beginning net working capital. How do we get net working capital? Well, net working capital equals current assets minus current liability. And we compare the difference between year 2009 and the year 2010 in this case, and the difference is $330, which means company invested $330 million in year 2010 in net working capital. Once we combine three numbers together, we can calculate cash flow for assets, or cash flow that is belong to both creditors and the shareholders. And here's another way that we can calculate cash flow for assets. And as we know, cash flow for assets equals cash flow for creditor and cash flow for shareholders. And here's an alternative way we can calculate cash flow for assets. First of all, we look at cash flow for creditors, then we look at cash flow for shareholders. And the cash flow for creditor equals interest paid and net minus net new borrowing. Net new borrowing can be obtained by taking the difference between total debt in year 2010 and total debt in year 2009. Right? So in year 2010, company borrowed more money from its long-term debt holder, right? And also all the debt holder receive $70 interest payment. The interest payment can be found in the income statement. Right? That will give you cash flow that is belong to creditor. And the second part is cash flow for shareholder. It essentially equal to dividend paid minus new equity that is issued. And here you see the equity has been increased. Equity has, common stock and paid-in surplus increased from 600 to 640. So $40 million worth of equity has been issued in year 2010, and also the shareholder received $103 million of dividends. So the difference here is cash flow belong to shareholder, which is $63 million. When you add up those two numbers, you will get a cash flow for assets, which is equivalent to the calculation that we followed in the previous slide, 87 million US dollars. Right. And this table showed you the formulas that we need to utilize to calculate cash flow from assets, and we should recognize that cash flow from assets is the sum of cash flow belong to creditors and cash flow belong to stockholders, right? And cash flow from assets follows two alternative formulas. The first one, we start with operating cash flow, then we minus net capital spending and the changes in net working capital. The alternative way is to figure out the cash flow from creditor and cash flow from stockholder, and both methods will come up with exact the same number. So before we conclude this chapter, let's take a quick quiz. First of all, what is the difference between book value and market value for assets, liabilities, and equity? Second, what is the difference between accounting net income and cash flow? Third one is, what is the difference between average and marginal tax rates? And the fourth one, how to determine a company's cash flows. Once again, this chapter gives you a pretty good review of Accounting 101, and in this chapter you need to understand what kind of information that we can get from the balance sheet, the income statement, and you needed to know the meaning of each every accounting items on those two financial statements. And more importantly, as finance people, we know that we are not supposed to produce financial statements. Instead, we use those information that we can read from financial statement to assist our financial analysis, right? So it's important for us to distinguish the difference between several different things, such as market value, book value, marginal tax rate, average tax rate, the difference between accounting earnings or net income and the cash flows, and also we learn a lot about how to calculate cash flow for assets. Any questions? Please feel free to drop your questions in the discussion forum of D2L or email me, and it's my pleasure to go through this chapter with you guys, and I will see you next lecture.